There is a ticking time bomb planted inside of the US economy. 2 days ago, I was reading an article written by Politico. The article states that as the federal government strives to contain financial market turmoil, the next risk looming over the nation's banks is in plain sight: the $20 trillion commercial real estate market. Some $1.5 trillion in mortgages will come due within the next 2 years. The potential time bomb is higher interest rates and spiraling office vacancies push down property values. The article goes on to state because 70% of bank held commercial mortgages sit on the balance sheet of regional and smaller banks, a write down in commercial loans could spell big trouble for the financial system and spill over into the larger economy just as the 2024 presidential campaign gets underway. With the country careening towards a possible recession, the financial system is especially vulnerable to shocks as the turbulence sparked by the collapse of three regional banks showed. Adding a commercial real estate market slide to the mix would be particularly perilous. It's a concern that's top of mind for policymakers in Washington, even as they acknowledge there's not a lot they can do to fend off crisis. White House economic advisor Jared Bernstein told a panel of lawmakers in April that the issue is very much on our watch list when asked about the potential for a significant downturn in the market. The best case scenario for the market is that a wipeout would be isolated to a few banks that have a lot of office loan exposure, according to Stin van Nieuwenburg, a Columbia Business School professor of real estate and finance. The office vacancy rate has hit 18.6% in the first quarter of 2023, well above pre-pandemic levels, according to an estimate from Cushman and Wakefield, which doesn't expect vacancy rates to stabilize until 2024. So the problem is the use value of a lot of this commercial real estate has diminished because people are working from home now. But it would be a mistake to conclude that the problems are isolated to the office market. Higher interest rates impact all types of real estate, Neuerberg said. The way these loans are structured, you're most likely paying interest, not principal. So you'll have to roll over most of the loan when it comes due, he said. The bank will tell you no because the interest rate is now 6% instead of 3% that it was 10 years ago, which means your building is now worth about 40% less than it was. Nuremberg said he would be surprised if 10% of commercial real estate loans can't be refinanced, especially as banks grow more cautious about lending against real estate. Roughly 5.4% of office properties with commercial mortgage backed securities, meanwhile, were managed by special services, meaning they were in some stage of delinquency in April, up from 3.4% a year before, according to TREP data. And because so few commercial buildings are being sold right now, it's not clear how bad it could get, since there's uncertainty surrounding how far office properties' values have actually fallen. They don't have enough data to tell you what the actual value of the market is and how far it could go down. We're at a bit of a logjam in the market right now because sales transactions aren't really taking place, which means that there's not a lot of clarity on where property values are. And that comes from Jamie Woodall, head of the commercial real estate research at the Mortgage Bankers Association. Without that, it leads to a sort of reluctance of buyers and sellers to come together on what a property is valued. Commercial mortgage loan originations in the first quarter of 2023 were down 56% from a year before, having fallen 42% from the fourth quarter of 2022, according to MBA. This is a major problem that's pending right now. Here's what the Fed had to say about this. The shift towards telework in many industries has dramatically reduced demand for office space, which could lead to a correction in the values of office buildings and downtown retail properties that largely depend on office workers. Moreover, the rise in interest rates over the past year increases the risk that CRE mortgage borrowers will not be able to refinance their loans when the loans reach the end of their terms. With CRE valuations remaining elevated, the magnitude of a correction in property values could be sizable, therefore could lead to credit losses by holders of CRE debt. Here's a chart of the largest holders of commercial real estate debt. And as you can see, banks, particularly large banks, hold 61% of the commercial real estate loans outstanding. Life insurance companies hold 13% of the total commercial real estate loans that are outstanding. Life insurance companies have a $500 million in commercial real estate loans, and banks total $2.17 trillion in commercial real estate loans. This is just massive amounts. And to cap this off, Mark Levine on Fox News last night went over a document which was the nation's fiscal health. This is a document that was given to every congressman and woman leading up to the negotiations of the debt ceiling. And it's just remarkable that staring in the face of economic collapse and a massive debt problem, both sides kept negotiating their partisan issues instead of reading this and addressing the actual problem that lay ahead. The thing is that politicians know that most Americans really don't care about the economy until it affects them negatively in the form of a job loss, layoff, something like that, right? They know that they can just come up with a short-term solution and make it the future's problem. As long as they can keep delaying and delaying and delaying the issue at hand, then they can move it past when they're being elected and not have to worry about it. It's not their problem. They're just shoving it off the table. They're major procrastinators, and eventually the chickens are going to come home to roost. So the highlights of this is from, by the way, the Government Accountability Office. They quote, "The federal government faces an unsustainable fiscal future. At the end of fiscal year 2021, debt held by the public was about 100% of gross domestic product, a 33% increase from fiscal year 2019. Projections from the Office of Management and Budget and the Department of Treasury, the Congressional Budget Office, and the Government Accountability Office all show that current fiscal policy is unsustainable over the long term. Debt held by the public is projected to reach its historical high of 106% of GDP within 10 years and grow to continue at an increasing pace. This ratios could reach 217% of GDP by 2050, absent any change in fiscal policy." Here's a chart that shows the growth or projected growth of the total debt held by the public from 1900 until 2050. And you can see just the crazy increase in the amount of debt. Like, it's exponential. It says in the GOA simulation starting in 2024, debt held by the public grows faster than GDP in every year. In most years, debt held by the public grows more than twice as fast as the economy in real terms. The growing debt is a consequence of borrowing to finance increasingly large annual budget deficits. The total budget deficit is composed of two parts: the primary deficit, which is the gap of non-interest program spending and revenue, and spending on net interest, primarily the cost to service the debt. So, as you can see from this chart, the blue on the top above the dark blue is the total amount of interest that will have to be paid by the federal government to service the debt. This is just the interest. This isn't even paying down the debt. This is just to keep the interest payments going to make sure that the debt taken on remains the most credit-worthy investment in the world, right? I mean, investing in U.S. Treasuries backed by the good faith and credit of the United States is the risk. It's the risk-free rate. Like, it's the most riskless investment there is. As this debt becomes more and more expensive and less serviceable, you're regardless of the debt ceiling here, you're really risking a financial collapse. And you can see as time goes on, the majority of government expenditures isn't even going towards any kind of benefit in the economy. It's going towards just paying debt. So you see this graph starting to level out with money that the government can spend for projects it needs to spend on or wants to spend on, and more being allocated just to pay for all the crazy spending the government did in the past. Again, this was given to every congressman and woman leading up to the negotiations of the debt ceiling. And what do you hear? Democrats want to just keep spending, and the Republicans are just as bad. Yeah, they may say they want to cut some spending, but no one is really going about the conservative way, which would be stop wasting money, cut spending across the board, don't increase the federal budget, let's pay down this debt, and let's move on. But the problem is that what's favorable politically is not favorably economical, and it's going to come back and bite us all in the